Hello everyone and welcome to the Garlic City Realtor channel. I'm your host Jeet Sangha. The past month has been quite challenging for mortgage interest rates, and unfortunately there's no sign of relief in sight. We're seeing the interest rate surge almost a full percentage point from 7.3% in July to 8.14% in October nationwide. For us millennials, this is quite hard to fathom. We often hear stories of interest rates reaching 17% or 18% in the 80s, but back then home values were stagnant and most homes were priced under $100,000. Nowadays, you can find an SUV priced close to that. However, what's astonishing is that despite these soaring interest rates, the real estate market in the Bay Area remains fiercely competitive. So let's take a look at what's going on. First, let's examine the reasons behind these rising interest rates. As you may already know, the 10-year Treasury bonds serve as a benchmark for mortgage interest rates. Currently, the Treasury yield stands at 4.87% as of the time of this video. You might be wondering what's driving up Treasury yields. Well, there are several factors at play, including the US issuing more bonds to meet its debt obligations, a strong US economy marked by solid consumer spending and job growth, despite the high cost of borrowing. This situation is causing the Fed to keep rates at the current levels for the time being, otherwise we may see inflation numbers start to rise again. Now let's explore the impact on the real estate market. We can all observe how interest rates are affecting real estate. Transaction volumes have plummeted by a staggering 47% in Santa Clara County since October 2021, when interest rates were at 3.3%. Whether you're a homeowner or a prospective buyer, you might feel trapped in this market. For homeowners looking to sell and move to a new home, the prospect of giving up their low interest rate mortgage is hard to stomach. Doubling your house payment is not an attractive option. For buyers, higher interest rates reduce their purchasing power. Did you know that every 1% increase in your interest rates decrease your purchasing power by 10%? So if the interest rate climbs from 7% to 8%, your monthly mortgage payment increases by 10%. This is why many buyers and sellers are on the sidelines waiting for the rates to come back down. There's a segment of population that thinks that home prices will crash, offering them an opportunity to swoop in and buy. However, here's the harsh reality. There are virtually no indicators pointing to a market crash. Yes, it has cooled down, but a crash remains unlikely. The underlying fundamentals are pretty strong for real estate sector. It's pretty hard to qualify for a mortgage these days. Lenders are very cautious when they're qualifying applicants. Second, the US economy is doing very well. The unemployment rate is low and we're seeing job growth month over month. Another reason we're not seeing the home prices crash is because of very low inventory. Homeowners who would like to sell are not selling because they would have to get a new mortgage at the current rates. Instead of selling, many homeowners are choosing to upgrade their homes or turn them into rental properties. Right now, really the only people who are in the market to buy or sell are the ones with specific needs, such as getting married, expanding their families, retiring, or relocating for work. There are other unfortunate situations like death, divorce, downsizing, or financial difficulties which may cause you to sell at this market. What can we anticipate for next year? Well, it's safe to say that we can expect much of the same in 2024. The spring season will likely start out strong and continue throughout summer. As far as the rates go, most reports that I've read point to the fact that the mortgage rates will remain high throughout the next year and may eventually come down to 6% in the last quarter of the year. Fannie Mae predicts the interest rates will range between 6.3% to 6.8% next year. The best case scenario for interest rates I've seen is from Mortgage Bankers Association. They predict the interest rate will come down to 5.6% in Q4 of 2024. It appears that high interest rates may become the new normal for several years, and the possibility of seeing rates below 5% is unlikely unless there is a significant economic downturn. So, should you wait to buy or sell? Well, that depends on your individual circumstances. Consider the reasons why you're buying or selling. Is it a necessity or a desire? Do you need to move because you live in an unsafe neighborhood, or do you need to be in a certain school district for your kids? Or any of the life events I alluded to earlier in the video. Those are all legitimate reasons. If you're considering selling simply because you've been in the same place for a long time, you might want to think about remodeling instead. If you're holding off on moving in the hopes of perfect opportunity with lower home prices and interest rates, you might be waiting indefinitely. If buying a house solves a significant problem for you, such as improving your quality of life, I'd say don't let the current market environment deter you. Ultimately, if moving to a new location enhances your quality of life and well-being, it's hard to put a price on that. So if you have the financial means to make the transition, I'd say go for it. Well, that's a wrap. I hope you guys are enjoying this content I create for my South County audience. If there's anything I can do for you, please do not hesitate to reach out. Until next time, be safe and take care.